The underlying thesis on my end and why you can stay bullish and stay long these stocks is because we can look through the SPR releases. We can look through a little bit of softening and see that there's a huge gap that's not because of ESG or anything that happened before February 24th of this year. That changed everything. When Russia invaded Ukraine, I don't think the generalists or the population at large, the investing public, understands how big of a hole that blew in the oil market.
Hi, I'm Jared Dillian, and I'm here with Warren Pies, the co-founder of 314 Research. And we've never met before. It's nice to meet you. I'm going to be talking about, I assume, oil today, energy prices. So when we scheduled the interview a few weeks ago, it was a pretty different picture in the energy markets. This is being recorded on July 5th. Oil's down about $10 today. It's actually trading below par. Big rally in the dollar. All commodities are getting crushed. It's the dollar wrecking ball. Has your thesis changed at all in the last couple of weeks? And maybe first of all, just tell us your thesis.
Yeah, absolutely. It's good to meet you, man. And it's good to be here. Talk a little oil on a day where it's down $10 a barrel. So it's perfect timing. No, I don't think my thesis hasn't changed at all. And just so everyone's aware, we provided one of our more recent oil reports from June 2nd that we're going to make available to Real Vision subscribers. So check that out if you want all the gory details. The bottom line from my perspective is that, we are undergoing a period of demand destruction right now. And so we've seen that in some of the inventory data on the refined product side. Refined product prices have been extremely high. About $175 a barrel is what we've been looking at from diesel and gasoline prices. And so demand destruction was kind of inevitable. But on the other side of that, we've seen the Russia-Ukraine crisis opening up a gap between supply and demand that is going to be very difficult for the market to solve for just on demand destruction. And that remains our core thesis. So we see when the dust settles from everything that's happening over in the Ukraine, we see about a 3.5 to 4.5 million barrel a day deficit opening up between supply and demand. And again, the average recession, when you go through your average recession, when you're talking about demand destruction, you lose about 1.5 to 2 million barrels a day of demand that you get peeled off from a recession. So you're still left with a market that could be in deficit, which is obviously bullish for prices. And it's abnormal to be in this kind of a position. It all opens the door up for stagflation and a number of other things. And ultimately, you get price action and big swings like this, and the futures market is a little stretched on the long side. But underlying everything, when we kind of zoom into the market, x-ray the market, look at physical market indicators, I don't see the weakness reflected in physical market indicators yet. So yeah, some inventories are softening. Gasoline demand, diesel demand is falling off ever so slightly now. And the economy is obviously losing steam. So these things are impacting price today, but our core thesis doesn't change.
So I don't follow you on Twitter yet. Maybe I will after this. But a lot of the big energy folks on Twitter, whether it's Doomberg or Tony Greer or people like that, what I never hear out of those people is any acknowledgement that demand destruction exists. You know what I mean? Like, you're really the first oil analyst that I've talked to that has said, yes, demand destruction is real and it results in a 1.5 to $2 million a day shortfall. And I believe it's happening right now, or at least it's starting, and I think that's really what's responsible for this drawdown in oil. Would you agree?
For sure. I think that there's a couple things. The market's had like a ton of bearish news flow thrown at it, and not just news flow, like real fundamental bearish events. And so it's not surprising to see it give back some of these gains. I mean, let's go back to right after the invasion, China does what, based on flight data that we track, the most severe lockdown of their country, given the zero COVID policy since February of 2020. So you had that, which is more than 1 million barrels a day offline right there. You've had obviously demand destruction from incredibly high refined product prices, like I said, between $170 to $200 a barrel, depending on the wholesale price and that you're capturing in the product you're looking at. So obviously you're going to get demand destruction there. We've always said that 5% of global GDP for crude oil price is where you start getting demand destruction. And we've been at that number. But under the surface, when you kind of go one step further and you look at gasoline, diesel prices, we've been at 7% of global GDP. So unsurprising to see demand destruction kicking in. And then the other big piece of the bearish puzzle has been SPR releases. So combined, the US and global SPR is releasing about 4 million barrels a day over the next 6 months. So that gap we're talking about, it's theoretically being filled up by this SPR release. So you have a lot of oil sloshing around out there on the global market, and you have demand falling. But it's important to think about, when you think about demand destruction, to think about the mechanics of the oil market. So when you or I pare back our expenditures on gasoline, let's say, based off of prices going too high, that's demand destruction, right? That's gasoline and diesel. But the ultimate buyer of crude oil is not you, me, or any consumer. It's an oil refinery. And so right now we're seeing crack spreads, refining margins at record levels. So even though we had a big drop today, you can't forecast any kind of slowdown in the amount of crude that's going to be consumed by those oil refiners. So refined product or crack spreads are still extremely wide, and there are a number of other indicators that tell me any pullback is going to be, relatively shallow. And you got to remember, this is the oil market, so it's super volatile, and 10%, $10 down feels like a lot, but these kind of days happen.
Yeah, one of the things you pointed out was the demand elasticity for oil. It's, it gets expensive and people drive less. Like, that happens. So some of the conversations I hear around here in Myrtle Beach, people are still driving to work. Obviously, they have to drive to work, but people who are lower income, middle income, they say, well, I was going to take a trip to Charlotte and that was going to cost me $150 in gas, and I'm not going to go. So those are the types of things that I'm hearing. And if you look at charts of miles driven in the United States, like, really just a 1, 2, or 3% drop in miles driven is a huge drop in demand for gasoline. I read something interesting recently that in California, they have a 3% drop in miles driven, but an 8% drop in gasoline demand because of all the electric vehicles that are being sold in California. So that's actually added up to, what's interesting is that all these years of selling Teslas and other electric vehicles, it's actually starting to have an impact on gasoline demand. Now, that's not something you can trade on, but on a 10-year basis, if you had a 10-year thesis, that's important to know.
Absolutely. And I would not run away from that realistic aspect of the market. It's certainly not something that I'm not a permeable, just so you know. So I hope you do follow me on Twitter. It would be, I just followed you today, so I'm looking forward to seeing what you put out there, even if we disagree. But I'm not a permeable, very realistic about the market. And what I would say is that we've seen a trend in miles driven actually going down for fuel gasoline consumption in the United States, really going back to the boom in SUVs and Hummers right before the GFC. So CAFE standards have gotten tighter, fuel efficiency has gone up, and we see that in gasoline demand. So there is kind of in developed economies, a trailing off of gasoline demand. But you have to remember nowadays, really the big marginal buyer of oil is in the emerging economies, which I think the emerging markets, and with dollar strength and things like that, demand destruction certainly coming there as well. So, I mean, again, the underlying thesis on my end and why you can stay bullish and stay long these stocks is because we can look through the SPR releases. We can look through a little bit of softening and see that there's a huge gap, that's not because of ESG or Anything that happened before February 24th of this year, that changed everything. When Russia invaded Ukraine, I don't think the generalists or the population at large, the investing public, understands how big of a hole that blew in the oil market. It's coming for us before too
So,
long.
so eventually we're going to run out of the SPR. I don't know if we'll take it to zero, but we're going to stop releasing oil out of the SPR. Um, I mean, one of the things I was thinking about today is at some point in the next 6 months, 12 months, the G7 countries are going to have a common interest in bringing this war to a close. You know what I mean? Whether it's because of gas prices in Europe or oil prices in the US, like it's going to cause a lot of economic pain. And the G7 just met a week or two ago, and everybody was on board except for France and Germany, and it's getting interesting. So I mean, I don't know if you're a geopolitical analyst, but what do you? I mean, if Russia and Ukraine is the primary driver of this deficit, what happens when that primary driver goes away? Because the war is not going to go on forever, and my guess is it goes on for 6 months, 12 months, maybe 2 years, but that's about it.
Yeah, now you're getting to a true bear thesis for oil and energy, and that's, let's say we had a true resolution of the conflict. And it wouldn't just be a ceasefire necessarily. From my point of view, it would need to be something that uh, where we roll back the sanctioning regime that's been put in place. And so it would have to resemble somewhat of a political calculation from the G7, because that we aren't going to take the pain that actually the pain that we are trying to inflict to Russia via sanctions is actually hurting us as much, if not more, than it's hurting them. I don't think that's, from my standpoint, I'm not really a geopolitical analyst. We're much more quantitative analysts and look at the underlying numbers in the market. But we can have an opinion. We have to have an opinion about all these things. And I have a hard time seeing how this crop of politicians can walk back the statements, rhetoric, and actions that they've taken over the last 4 months regarding Russia and the sanctions. And you have certain things in addition to that I don't believe we can roll back from. And that's basically the exodus, the brain drain that's taken place in the oil and gas industry from Russia. In the history, when you see Western oil companies leave a country like Russia, history tells us that production falls off and it becomes a terminal decline.
Yeah, it was the same thing in Venezuela.
Correct. I mean, yeah, you're talking about a country with the largest reserves in the world. We've had terminal decline there as well. And so even if we go back, let's say there's a ceasefire, some kind of agreement there, do Western companies go back into Russia? I have a hard time picturing that. We have to have a real sea change in the narrative, the public zeitgeist, whatever you want to call it, in order for that to happen, in my view. So I see
like
this
even if the war ended, like how do you walk back these sanctions? How do you walk back that rhetoric? I mean, it's impossible to do.
Yeah, I mean, there's some cynical. You could take a very cynical view to it and say, like, maybe they don't believe what they're saying 100%. But I think there's just like many things in our country these days, I think this is pretty split down the middle. So the big risk to me is you go through an election cycle, and the next election cycle brings in a set of political leaders that change policy in Russia. And this is when I say risk, we're agnostic politically. If you're going to make money in markets, I think it's important to be agnostic politically. So whatever happens, we're just weighing the odds and the probabilities that's going to happen and reacting to it. So I think as long as the kind of the Democrats and more or less the current crop of globally focused NATO strengthening type of leaders are in power, I think these sanctions remain. But that thesis does start to potentially change at the next election cycle, depending if Trump were to be reelected. I think you have a totally different posture towards Russia potentially.
Yeah, for sure. Even DeSantis probably.
Yeah, I think that's exactly the way things are breaking down. And it's fair to ask, like, does the American, I think we framed this question last year when it was with regards to globalization. It's like we made a deal basically manufacturing the majority of our products when we let China into the WTO in 2000. We made a deal for cheap goods, and we gave up control of our supply chain. I think COVID kind of made us realize the political trade-off that we may not have been aware of back then. And I think that over the next few years, we had SPR release and a few things. We're having economic softness right now. Over the next few years, if these sanctions remain in place, it's going to be a very similar thing. The US voter is going to become acutely aware of how much damage these sanctions are doing to their personal economic fortune. We're raising prices prohibitively. We're siphoning off a big portion of our hydrocarbons to Europe because they're in even worse shape than us for sure. So it's going to be a mess, and there's going to have to be political will to hold these sanctions up. And
I think that American voters are okay with making these sacrifices in principle, but when it comes to practice, they don't. So, it's kind of like going into the 2016 election. You had a lot of Republicans who were saying, for sure, I'll pay higher prices on stuff. Let's put tariffs on China. I'll pay higher prices on stuff. And now we have 8% inflation, and it's like, holy shit, like this is a problem. So it's I think when the Ukraine war started, I think people were very principled, but now that we're 4 or 5 months into it, and there's all this economic pain, I think people are starting to waver on this a little bit.
I totally agree. I mean, but I do believe what we're talking about now is the true bear case. Like the recession this time, the way I see the market is we're going to have our recession probability model is just slightly over 50%. So let's say it's a little bit better than a coin flip or having a recession. I think we're starting to trend that way. There are some mitigating factors, but let's say we have a recession. I think oil bucks the historic trend and stays strong, at least flat, let's say, during that recession period. And then we come out and it starts, cranking as soon as any kind of economic strength picks up, the SPR barrels dissipate. So you're going to get a real test of political will, I think, across the spectrum. And I don't know. For me, it's difficult to judge how much will there is and how much pain the average voter is going to take. Just like you said, I think we lifted tariffs today, or that was announced today. So we're full circle on that policy.
Well, I think, with gas at an average of $5 a gallon, I think people are squealing, but you get it to 6 or 7, and that's going to be, there's people are, they're going to have the pitchforks for sure. So,
Yeah. And the big part of your piece in the post that I agreed with was that oil is driving everything right now. And so the pain from higher oil prices is going to be exacerbated because if prices keep going up, it's trigger for the politicians, which is a feedback loop to Powell and the Fed. I mean, we've gone from a Fed that ignores headline inflation to a Fed that's going to fight headline inflation. We're seeing headline inflation, core inflation diverge. In our estimate, it's about 40% of the delta, year-over-year delta in CPI is all related to oil and energy. So oil has become the thing that's running the market. It's running the political discourse, just like we've been talking about, and whether we're going to keep sanctions on and things like that. It's running the Fed, and it's ultimately running the market through those channels.
now, did you see the tweet from Biden over the weekend about screaming at gas stations to lower their prices?
Yeah, I actually did. I think it was his press secretary. I did it like some kind of quote retweet, which is not typical for me. But yeah,
I mean, so part of the bull thesis, and I would say most of the bull thesis, has been government incompetence, right? Like they don't get it. They're not encouraging investment in oil and gas. They're hostile to the fossil fuel industry. They're hostile to fossil fuels, and this is driving all the decision making, which I mean, I think there's a lot of symbolism here. I think if Biden came out and said that we are open to energy investment, then oil would drop $20 on a rope. I think that's really, there's a lot of symbolism in what he says and does. What do you think?
I think, to be totally honest, I think that part of it is overblown by the bulls somewhat. Um, I just have to. I mean, I think the incompetence is certainly there. I mean, the energy incompetence in the administration. I mean, the tweet that I remember was, basically just showed total lack of understanding of how the refining process works and how what it was basically trying to make gas station owners and oil refiners out to be monopolistic, and they're the least monopolistic industry. They're price takers on their inputs. They're price takers on their outputs. So it's ridiculous. It shows a lot of ignorance on the part of the administration. But with that said, there's only so much you can do. I mean, I don't think that I don't think that the pipeline denials or all these things have slowed production a little bit, but that is a drop in the bucket compared to what's happening. If you say that the political calculation that's holding oil up is the sanctioning over in Russia, then I'd agree with that. But I don't think that's what the bulls are talking about. I think they're talking about some kind of nebulous regulatory apparatus that's holding back oil production here. And I'm skeptical that that's really doing very much. On the margin, yeah, we probably would see oil fall a few bucks if they came out and said we're now going to be oil friendly or whatever. But ultimately, it would evaporate quickly, because the real problem out there is the fact that we just knocked Russian production offline, more or less.
So if you were president, what would you do to get oil and gas prices down?
Oh wow, that's a good question. I think that if my sole objective was to get oil and gas prices down, I would back off on the rhetoric towards Russia. Number one, I mean that's the real problem. So it'd be the first thing I would do if all I cared about was getting gas prices down. Then I would work with the G7 nations to roll these sanctions back. And that might not be a popular answer, but that's the true answer. If you want to get gas prices down immediately, that's what you do. Outside of that, you're kind of just rearranging deck chairs on the Titanic to a certain extent. But what you do from a more universal perspective, once we set the sanctions aside, is create an environment where oil and gas companies can invest with some semblance of stability. Right now, there is no stability. They don't have an expectation of what the industry is going to look like in 10 years. They've lost money. The industry's lost money for 10 straight years, and now they make some money, and they want to talk about doing a excise tax on profits and things like that, and they make more money than God. All that rhetoric it creates instability in the investment side, and I think you want to harbor we don't want to be reliant on unfriendly jurisdictions for our oil and gas production globally. So we want to harbor kind of investment in these better jurisdictions. So it'd be United States, Canada. Politicians in these countries should, if they want to bring the price of gas down, they should try to engender that kind of an environment.
Yeah, I mean, if you're going to drill a well, that's a 20-year project, and that's basically five presidential administrations. I mean, for sure, at some point over the next 20 years, you're going to have somebody up your ass. I mean, that's just you know, like
Yeah.
that's for sure going to happen. So,
Yeah. I mean, the energy sector became the highest yielding sector back in April of 2019. And I think that was the market's way of saying, okay, enough of the BS. We're not just going to give you money to drill holes and to produce negative free cash flow. We want a return on our capital. We want a short payback period. You are a short duration asset. We don't know your future. We don't know what's going to happen. ESG, climate change, all these different things that could shorten the useful life and bring forward the terminal value of all these assets. So I think that's the environment. It's a rough, and you need to get your money back fast. So there is a restricting factor on how high the valuations on energy stocks can go because of that.
so let's put some numbers on this. So, let's say in a couple months the SPR goes away, the war's still going on, we still have this 4.5 million barrel deficit. Prices go back up. Where do they go to?
I think we'll be back to we're going to be at new all-time highs. Let's put it that way. I think we will be, once we eat through the SPR, you might see refined product prices. See, here's the thing. You could have oil prices go to 150 bucks a barrel, have gasoline and diesel prices stay the same where they're at just where they're at right now, and you still have an above average refining margin. And that's the mechanics of the oil market I'm talking about. So you would need to see a big time haircut on refined product prices in order to kill off enough processing from refineries and ultimately hurt true underlying crude oil demand. So I see this as a market that is moving inevitably to new all-time highs. And I think energy stocks are going to be re-rated because of what we're talking about, that there is going to be coming out of this an appreciation for energy security and that we've really neglected over the last 10 years. It's been easy to neglect when we've had just, endless amounts of shale and low interest rates subsidizing that investment. It's been very easy to neglect that. I think we get a re-rating higher of these energy multiples, even after you adjust for new oil prices. It's a great hedge for portfolios. I'm buying dips and preparing for those days.
150. Yeah, that's actually what Tony Greer said to me the other day. He also said 150 was his number. What's interesting is that, so I don't know how much you know about me, but I trade on sentiment. So, what people are saying, what people are doing. I pay a lot of attention to Twitter to see what people are talking about. And this was a month ago, and I had a conversation with my futures broker, and he said, "Hey, Jared, you gonna play any oil?" And I'm like, "No, like it's too hard. I have no desire." And he said, "You would not believe the number of calls I get from people asking how to play oil to 200 bucks." He said, the phone is just ringing off the hook. Everybody wants to buy oil. And I said, "Oh God, like that's the indicator." And the trade was, I bought puts on XLE, and XLE went down 20%, took profits. But the sentiment was getting really, really hot in energy. It was getting really, really hot. I think it's kind of back to neutral, maybe even a little negative right now. I think it's actually a little bit negative. So if you didn't have a position, where would you buy?
If I didn't have a position, so I'm marked by the scars of the last. So to give you a little more about myself, I think sentiment's a huge important factor. My previous position, I was at Ned Davis Research, and I think as a shop we were kind of known for our sentiment work. So clearly, it's a real factor when you're trying to figure out what's the magnitude of potential returns. And the other part is we cover everything now at 314, but I was an oil and energy analyst for many years, and the scars of the last 10 years are with me. If you were in that market, then it's really difficult to be coming out here and pound your chest and pound the table and be bullish. So I would be buying large cap integrated stocks, number one, if I was just kind of a widow and orphan. And if I was a little bit more creative, you look at stocks, large cap, upstream stocks, and some integrated ones up in Canada. I think Canada is going to be the big winner of all of this. And so we've been recommending all the way back since the very end of 2020, beginning of 2021, C&Q and SU as large cap Canadian producers. I think this dip is huge, is a great buying opportunity for both of those stocks. In the United States, I think you're doing okay buying like an Exxon here because you're getting some refining exposure, and there's no telling how this whole refining capacity shortage is going to go. So Exxon is fine. And if you want a midstream gas exposure, I think Williams, WMB, was a stock I was recommending on Real Vision back in like March of 2020 when that thing was down in the low teens, and now it's at 30, but it was up as high as 38, 39. I think this pullback, you're not going to double your money there, but it's a great place for long-term capital. You find some of the best midstream assets in the United States and in the world, really. And so that's kind of the picks that I would do. And if you don't want to get into individual securities, XLE is dominated by Exxon and Chevron. I think you're going to be just fine there. The one place I wouldn't go or be super eager to go into are refiners. It's just
I
pure
was
play.
just going to ask that. I was just going to ask that.
Yeah, I mean these margins are not sustainable, and I think when you talk about the demand destruction story, these are the refiners. I used to do an analysis where I went through every single industry and would check their different valuation multiples and look at how they move versus key metrics. And for refiners, we look at margins. And there's this really strange, it would be an unintuitive negative relationship where as refining margins expand, your multiples actually contract. And that's the market's way of saying this is not sustainable. So whenever you do valuation work, you have to adjust for these things. Refiners are one of the most cyclical industries I found in the entire market. So going into a downturn, you don't get any real oil beta with refiner. It's a spread play. So yeah, I'm going to shy away from refiners. And if you want refining exposure, because we are in an interesting backdrop right now, you get an integrated stock like a Exxon, Chevron, or you go up north to Suncor.
So, since you were at Ned Davis, you understand some stock market stuff. So, back in 2020, the energy sector was like 2% of the S&P 500. And then on the highs recently, it got to 4.8% of the S&P 500. But you have a lot of people who look at this and they say, well, it used to be 13 or 15% of the S&P 500, therefore it could triple from here. Now, that sounds like a bad argument to me, but I don't know why. Maybe if you can explain if it's a good argument or a bad argument.
Yeah, I mean, there's a lot of bad arguments when it comes to energy stuff, and that's it's not a very rigorous argument. Let's put it that way, because it used to be there. We can go back there. You could say it's some kind of the most generous interpretation or argument I would say is this, and what we found is the energy sector and oil move in these kind of 8-year cycles. And I would call them multi-year mean reverting cycles. And at the top, last time we did see the energy sector about 12% of S&P 500. And then we went actually off the rails during COVID. I think it was kind of a diversion from the normal cycle. And we went all the way down to 2%. So if we were to follow that exact pattern, then yeah, you could get back to 12%. But there's how the other stocks do within the market, how interest rates move, and how big tech has now become such a big part of the market. It's impossible to really go back to 2007 or whatever that print was and say, oh yeah, we're going to go back to that, because the world's changed. The market itself was way more cyclical back then, and it's a totally different animal now. So I don't think it's a great argument.
Now, one thing I've noticed is that the energy markets usually follow narratives, and you have a period of time where everybody says we don't have enough oil. Then you have another period of time that says we have too much oil, And the last big turning point we had, prior to this one in 2020 was 2014, where going into 2014, oil prices were still high coming off the financial crisis. And then you had North Dakota came online and started producing a million barrels a day, and the shale producers, and oil went from 100 to 30 in a couple of months. Do you foresee any kind of big sentiment shift? What would make us going from having this mentality of not having enough oil to having too much oil? Is that even within a 3 to 5 year timeline?
Yeah, it's always possible. It's always possible. I think that the number one, not to be a broken record, but the number one thing is what happens with the Russian sanctions. So let's say the world decides, hey, the juice is not worth the squeeze here. We're going to back off on sanctions. That gives us right away a huge pressure relief valve. We also have Iranian oil, which I think is going to come back. So when that oil comes back, that's more barrels on the market. Some of the shale estimates are crazy. I think that's all obviously price dependent. Shale's not going to roar back at 60, $70 a barrel. So you need to be sustained triple digits for years. And then you could potentially squeeze a lot more barrels out of the Permian Basin, for instance. And then you have maybe the other side of the sanctions is the regulatory apparatus, and maybe the consumer behavior changes somewhat organically. And then there's some combination of political regulations and moves towards this kind of green future. that we go through a high spike and then we actually kill off structural demand at some point in that. So, yeah, I mean, it's always possible, but my base case, that's not my base case. I don't think that's going to happen. When you look at hydrocarbon consumption, we've consistently grown and we've modeled it out. We see hydrocarbon consumption, total hydrocarbon consumption growing all the way out to 2040. And that's really because when you think about, even if, and that's under aggressive decarbonization assumptions. So if you think about just the global economy.
Is that because of emerging markets?
It's because just the whole pie grows. So even if hydrocarbons become a smaller piece of the pie, and you move to renewable energy is in the most aggressive, reasonable way we could see, you still grow the pie. So the overall necessary energy use grows, including hydrocarbons. So I don't think we're getting to peak oil demand anytime in the next, let's say, 18 years. I think we grow right out to 2040. It's hard to see beyond that. And there's so many different moving parts there.
Now, one last question. We haven't talked about the Saudis. What are the Saudis going to do?
The Saudis, well, that's one of the most bullish things in the market right now is we've seen Saudis increase their OSPs, their selling prices globally across every grade and every to every region. And these are basically all-time high OSP spreads. I don't see a lot of people talking about that in the market, but some keen economists I speak to, they think that in this economic backdrop, and I'd have to agree with them, the Saudis have an outsized control on pricing at this point in time. So they're able to more or less name their price with the tightness in the global market and push prices around. So another reason I don't see this sell-off moving much farther is you just saw Saudi OSPs that Asia hit an all-time high. They've been at an all-time high to Europe and the United States. And I think that they're going to keep pushing up prices. I think, their spare capacity is about tapped out at this point. So I think that they're going to manage market share more through pricing strategy versus production, which is kind of a big difference from 2014. When you go back to 14, like you were saying, that's where shale's rising. The Saudis see the rise of shale. They want to crush it. So they start producing all out and they have a market share war. We don't have the spare capacity to have a market share war at this point in time. So I think
that makes sense.
Be a strategy.
That makes sense. Hey, Warren, thanks for being on the interview. I had a good time talking to you. And you're right. You're definitely not a permabull. I appreciate it.
Thank you. Yeah, man. We're just trying to be right. Not trying to, do you want to be right or want to make money? We want to make money. So
yep.
That's all that matters.
Man unto my own heart. All right. Thanks, Warren.
Awesome. Nice to meet you.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.